Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right. So our strategy basically, though, one thing I want to point out, myself personally, I highlighted this resistance area, this support area, because I'm trading mean reversion, guys, which means prices that go to extremes up here and down here. I like to trade those markets that go to extremes back to the mean or the middle of the chart. A lot of people like to trade all over the chart, in the middle of the chart. To me, the areas of resistance and support are the ones that are farthest apart, like a football field. Okay, you play the game in the middle of the field, but you don't score till you get to the opposite ends of the end zones. So the way I like to trade these areas, especially with the ISE FX options and that, I kind of go for the extremes. And in the meantime, I look for other opportunities and other assets. All right, coming close to the end here, we've got the Swissy where we had the possible bull flag. And we were looking for either a test of the lower bull flag line or a breakout through the top to take a trade on that trade back in June last year. I'm going to point this out. I really didn't highlight it, but this is one of those situations where you had a decline, a sell-off followed by a basing period and a rally. So a pullback down to this lower trend line here is really just a test of the origin of this move higher here. Remember what I said, if the market's basing and rallying, I'm looking to buy dips. Some people don't like to buy dips. They like to buy prices as they're rising. But if you stop and think about it, you're going to pay more when they're starting to move in your favor, especially for call options, because the market makers have to jack the vol. They don't know what's going on. They don't know who's on the other side of the trade if somebody knows something. So either entry would have been a nice entry. And we did get past our first target here. We did get all the way up here. We actually based in this area up here and made new highs from there too. Kind of mentioned that kind of just to plan for some kind of a stop loss or protective hedge, just to buy puts again. Nothing really outstanding. We wanted to take off our hedge because we hit that resistance on the dollar index. So we wanted to make sure we took our profits on the puts. That did a nice job. It did collapse down to 106. So this thing, again, like the euro, pretty much topped out here between 118 and 122 and came right down to the origin of where that bull flag was at the beginning of the year. And like a super ball, just bounced right off that support the first time, V-shaped recovery. Okay, so then I made a mention in January that we moved into a trading range between 118 and 122 during November and December, and then completed the four-stage cycle the week of December 19th. We tested the original breakout area, and that's when the downtrend ended. But the 118 area becomes key resistance at this point. And here we kind of rallied right back up here again in February. And because there's sellers up here, price can't make a new high until the last seller sells. There's where your options are going to, really lose their time value in a hurry, guys. Can't ignore this kind of stuff. If you're thinking it's going higher and you're seeing something like this, be really, really careful. Okay? Eventually, we hit that 118, and we kind of sold off from there, and that's usually what happens. And we're back down here testing the support now. So the dollar completed the four-stage cycle, rallied back up, and it's down here again. So mini cycles inside of big cycles. And on daily charts, this topping out here in February really couldn't get a retracement to be a part of that. You sort of had to have that put for protection like we suggested, or to actually speculate. It's only two ways it can go here. Really, that's where your straddles and your strangles sometimes have a really good possibility of paying you. It can only break out to the upside or the downside. It's going to break out one way or the other. You're not sure of the move. There's a strategy that you want to use too. And kind of lean towards a a possible breakout, especially on a high time frame chart to the downside, especially after a big move like that. So again, in February, I'm thinking back here, we had that weekly resistance. We had daily resistance at 119.50, and that was where I was looking for the reverse at the 119.50 level. First target would be 116 because there was a rally there, so it would be kind of tiny for a profit zone, but depending on which strategy you're actually executing, if you're doing it on a daily chart for a quick move, it's not really that big of a profit zone. Okay, traders trying to buy pullbacks to any kind of uptrend lines during this point of time should use a pivot low for a stop loss and the 119.50 area for a target. So when we look at our daily chart, we were testing this trend line at the time, and there was our 119.50 area where the resistance was. Not really much of a profit opportunity for a long trade, so I always want to point that out. And there, as you can see, that's when we actually, on this week here, just the beginning of March, that's when we tested this level and prices just collapsed. So that's, again, the strategy. You can only trade what's in front of you at the time, but you can prepare for possible entries at these 119.50 areas based on what the price did the last time it traded up there. And here's our most recent chart now, 7-9. We're sitting on a little bit of a support area. We actually had a pullback entry to this support area earlier in the month of June. Aren't really going anywhere. As of 7-3, we're making some kind of a triangle, and it looks pretty much the same as the other dollar charts. If there is some kind of a counter trend intermediate term rally here for the dollar, this could definitely run up to this 116, 119 area next. And maybe what you want to do, though, is if you do stall out at this first area, that's a pretty decent gain. So just make sure you close the trade, especially if you start the base here, in case the downtrend resumes. And there's the opportunity to short that rally right there in the beginning of March. Only, again, if you're aware that the last time prices traded there was a lot of sellers. So, you know, people that tell you that there's not a lot of information on a chart and what happened in the past is in the past, well, these are actually the clues based on what Sam Seiden taught me. There's still orders up here to sell. And when price gets up here, believe me, there'll be sellers. And if not, price goes higher, and that's a loser. All right, we'll finish up with the yuck, guys. Kind of the dollar versus the yen, two currencies that were actually part of the carry trade. This one really didn't do very much for us on breakouts. Kind of retested the breakout almost immediately in the beginning of July. Was one of those situations where we rallied after that breakout up to 110, and it was pretty much on November looking for a strategy to trade the 92-100 trading range down here while it was in here. If it breaks out of the bottom, of course, you would hold on to those puts because it's possible at this point it could go down and make new lows. We don't know this is going to be a reversal at this point. Notice how many times here we based and dropped from this area. So this had a chance to do either one. Okay? And as it did break out of that little trading range and actually did make new lows. So some suggestions were to buy the 90 calls back in the beginning of January. Hold them with 100 as a possible target. All right. And again, only because I expected prices to kind of stay inside some kind of a channel for a period of time after that big of a sell-off. So we said the new range, once we broke out of the bottom there, would probably be 87.50 to 95 in January. So the plan becomes to trade the range as long as it stays inside the range and prepare for a possible breakout to the upside or downside, actually. Either one. Be prepared.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.